All right, hello everyone. Welcome to Coffee with Marcus and Mark. This is a delayed, condensed version of what we usually do because Marcus and I did a video and it didn't go live and it didn't record. We were gonna give it a go, another shot anyway, or try. We were going to try and give it a go. There we go. But Marcus has a meeting, so I decided to record a quick video. Uh, let's do it. Let's dive right in. We'll just get to the point here with this one. And let me go ahead and share my screen. So here we have the S&P 500 and a real interesting day here. Actually, it's been an interesting week. If we look at a weekly chart, right now the S&P 500 is down 2.5%. So the worst week since late October. And we're still kind of within this trend, this uptrend, even though we've pulled back significantly, had a couple of down days here. We also have round number support around 4,000 in the S&P. So we could draw a little trend line here. And there we go. Or a resistance level at this point since we're trading below there. And we could apply a 200-day moving average and see that the market is kind of at this point where we're ready to move. We're ready to do something. And I believe that is going to take place. That move is going to happen next week. But before we talk about next week, if we look at the economic calendar, we do see that there was a report today that was significant, red flag report, core PPI and PPI. And this actually had a big impact on the market. Core PPI 0.4% higher for the previous month. This was higher than expected. The forecast was 0.2%, and PPI excluding food and energy at 0.3% versus a 0.2% expectation. So this is telling us that from a wholesale level, prices are higher than expected, right? So inflation is still an issue, a bit of a shock here for the market. And if we look at a 5-minute chart of the E-mini S&P, so we can see overnight trading, you'll see that things were up nicely before this report. Here we have the move higher, and wow, things were looking pretty good, and a big drop. Let's see exactly how much this was. So we lost about 0.8% in the S&P 500. At one point, it was down 1.4% from where it was trading before. However, since the markets have opened, we're just kind of drifting higher. So it looks like traders kind of shaking off that move. If we look at the S&P and we go to a 5-minute chart, so we're not seeing any overnight activity, just the trading session. And we see that things are just kind of plugging along a drift higher, at least in the morning as we head into the weekend. Now, that doesn't surprise me because next week is going to be a busy week. Looking at the economic calendar, you see core CPI data on Tuesday. So this is a closely watched report that the Fed definitely takes into consideration, and it's the last major report before Wednesday, which is also going to be a big day for the markets and the economic calendar because Wednesday is when the Fed wraps up their 2-day policy meeting and they release their FOMC statement, their economic projections at 2 p.m., followed by a press conference at 2:30 p.m. Eastern time. So you'll usually see a two-part reaction, actually a three-part reaction. One is the initial reaction to the statement and Fed funds rate. At this point, 50 basis point rate hike is priced into the market. So that shouldn't be a surprise unless it is a surprise and they do something different. But there's an initial reaction at 2 p.m. Eastern, followed by the press conference where you get that Q&A or the comments on the Fed, their statement, what they see happening in the future. And this can definitely be a big deal for the market. So I think that's right now what traders are focused on and waiting for. Even though PPI data did come out higher than expected, or that number in the previous month, the decrease in energy was great. However, that was offset by an increase in food prices. So kind of a wash there, and actually were higher than expected. So CPI, a little more significant. Traders usually put a little more weight into CPI, what's happening with the consumer, but it's going to be a busy week next week. And so right now, markets are slightly higher. The S&P up 0.2%, Dow basically flat, the NASDAQ up 0.4%, recovering from a bit of a dip early on in the morning. Now, if we go to PowerX Optimizer here, with it being an update, not a whole lot popping up on the list, but what Marcus and I discussed in the recording that was not meant to be, we talked about his NVIDIA trade, and I want to bring up NVIDIA because he's done an outstanding job managing this trade, and NVIDIA is just screaming higher. So right now he has the NVIDIA 175 call that he sold expiring today, and NVIDIA is selling at or trading at 175.14 right now. So he has a few options, and we talked about it this morning in a session that we did. One, he could just let NVIDIA get called away. He's up nicely on this trade. Based on that 175 call and his cost basis, he'd be able to make about 15 grand just on that rally. So that's not too shabby. But he can also roll. And if we go to the calculator here, the calculator helps us make a more educated decision. And with a group today, we were talking about 3 different scenarios. One would be, well, let's look at this middle scenario first. One would be rolling out from the 175 expiring today to next Friday, the December 16th expiration. And right now, if I'm looking at the credit that could be received, it would be $5.25 most likely. So rolling for $5.25, that would give him another $5,775 on the trade. Now, another thing that he could do is if he was a little bit bullish on this one, he could roll out to out and up, so extending the trade for another week and rolling up. Right now, he could get $3.10 potentially on that roll. There we go. So $3.10 credit, locking in $3,410 and potentially making an extra $5,500 on the stock increase, right? Because if he rolls up to the 380, right now he has a 375, he makes an extra $5 on the stock. Only if the stock is trading above 180 and he gets called away at 180. So that doesn't come without risk. This would be more profitable, but it's not guaranteed. Where rolling out to 175, he is looking to take in $5.25. That is guaranteed whether or not the shares get called away at 175, or even if the stock drops, at least he has that 525. Now, there was a question about rolling down from 175 to 170, and we looked at this, and this is where at face value, sometimes that big credit looks appealing. But at least for me, this would be the last thing that I would want to do in this scenario, because we're sacrificing $5 on the stock, right? If right now the stock's trading at 175 and we roll down to 170, we're giving up $5. Yes, we might be making 750 on the credit from that roll, but look at this. With the 175, we're not giving up $5 and we're making 525. So yeah, this is a little defensive here, because if you think that the stock's going to drop, now you're collecting that 750 and it's lowering your break even, but you're giving up, you're sacrificing $5. So, at this point, I'd probably lean more towards letting it go rather than giving up the $5, because ultimately this just gives you a $2,750 profit on this roll, even though you're taking in $7.50, right? So this would be the least beneficial, in my opinion. At that point, it might make sense just to not have any risk on and to let your shares get called away. Although the 175 and 180 rolls are something to consider. And if we look at a chart, we go to NVIDIA here. NVIDIA is looking pretty good. I don't have exactly what Marcus did, what his break even and cost basis are, but I want to say his cost basis is about 160.50, and I think his break even's down here about 139, right? So if he does stay with us, what's the risk? What's the trade-off, right? That $5 credit on the roll, that's awesome. But the risk is that this falls, right? And next week is a market moving week, right? With the Fed speaking, we could continue to rally. We could pull back. Right now, we kind of have this range between 150 and 170, and it could fall to this lower range. If we look at where this could go, it looks like we might have some resistance around 190, 195. So with this break to the upside, there is potential room to move and a little resistance higher. I think the most likely scenario if it pulls back would be somewhere between 150 and 160, but it could be worse, right? So there's always going to be some risk once you stay in the trade. That's why when you go to roll, the first thing you want to really ask yourself is, does it make sense to stay in the trade for another week? If the answer is no, I wouldn't worry about the credit. If the answer is yes or maybe, then look at the credit that you could receive. If the roll makes sense, that might be considered. Our rule of thumb is to roll it at 60% annualized credit, and with a five and a quarter credit on that roll out, Marcus easily has that. So curious. First of all, I know this was just a late video, kind of spur of the moment. Let's get something together because the recording and live session did not go through. But if you liked it, give it a like on a Friday, but also post below what you think Marcus should do. There are 4 options. One, just let his NVIDIA shares get called away, bank that profit, move on, and have that extra buying power be free and clear going into next week. 2, roll out. So you are looking at rolling the 175 expiring today out to next week's 175, taking a 5 and a quarter credit. The third thing would be rolling out and up, rolling from 175 to 180, so we can make an extra $5 on the shares and take a $3.10 credit, or roll down from 175 to 170 and take that 750 credit, although that would really only result in about a $2,700 profit based on where the stock's trading right now. So post in the comments what you think he should do, and we'll make sure to update you on Monday. Until then, have a great weekend and happy trading, everybody.